Get Rich Education is brought to you by Norada Real Estate, the Real Asset Investor, and Mid-South Home Buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to GRE. This is Get Rich Education, episode 118. Hi, I'm Keith Weinhold, back to help you build your wealth and bringing it back with impact, regularly dishing you a life-changing lifeline. We're going to talk about risk in real estate investing today. How comfortable are you with risk? And you're going to find out something about my risk tolerance. And then later, we're going to bring in a great guest to compare real estate investing with some other investment classes like stocks, businesses, gold and silver, and commodities. Let's talk about risk a bit here. With risk, Rich Dad Poor Dad author Robert Kiyosaki says, don't play it safe, play it smart. Let's talk about real estate loans. What's risky there? What's playing it safe? And what's playing it smart with loans for 1 to 4 unit properties and then for larger apartment buildings? When you put a buy and hold property in your portfolio, you're not just tied to a geographic market and a property for the long term, you're typically also tied to a mortgage for the long term. Well, first, with 1 to 4 unit properties, that's single family homes, duplexes, triplexes, and fourplexes, you've got those two main choices there where you can secure a fixed amortizing mortgage of either 30 years duration or 15 years duration. In almost every case, I say take the 30-year, but that depends on you. In fact, on my single-family income properties, I choose the 30 over the 15 for every one of them. Well, you can show me that with the 15-year loan, you will pay less interest over time. 15-year mortgage rates are about 0.75% lower right now. Well, that is about the only advantage of the 15 over the 30. I like the 30. If you're a cash flow-centric investor, you've got to consider that your cash flow will be several $100s a month lower with the 15 because you're trying to get the loan paid off in half the time. Each month, your payment on the 15-year erodes your leverage ratio faster. Don't you want leverage? A higher monthly payment on a 15-year loan also increases your debt-to-income ratio, and that can create a headwind for your qualification on future loans. And be mindful as well that with the 15-year loan, you're building equity faster. In a sense, that's a bad thing because think about where else that money could be. Because as I often say, the rate of return from property equity is absolutely zero, and that will be true until the end of time. And if you don't know what I mean, listen to episode 46. With the 15-year loan's higher payment pinching your cash flow, you now bear the opportunity cost of not vacationing or not affording ice skating lessons for your daughter or not being able to invest in more property. Homes are not meant to store cash inside. Homes are meant to house people, whether that's yourself and your family or your tenants in your income property. Let your tenants pay down your mortgage balance for you. When you send extra principal payments to the bank every month, which is basically what you're doing when you get a 15-year loan, think about this. Here's what you're telling the bank. Hey, Mr. Banker, here's an extra principal payment of $300. Don't pay me any interest on it. If I need it back, I'll pay you fees, plus I'll borrow it back on your terms, and I'll prove to you that I qualify again, okay? That's neither playing it safe nor playing it smart. And if you think paying down your principal balance faster is more safe and less risky, well, that is absolutely false. The truth is just the opposite. Building equity is more risky. And again, episode 46 is where I spend an entire episode discussing that. So yes, I emphatically like the 30-year fixed amortizing loan. And I used to think 15s were better, and I even had one of those on my primary residence at one time until I learned better. Well, what about risk and mortgage loans on your apartment buildings? Okay, now we get into some different loan types, and there are a ton of apartment building loan products, but for the most part, we're talking about residential apartment buildings of 5 or more units here, which are actually called commercial loans, even though they're for residential property. Well, then we start running into something called balloon loans. There is a risk strategy around balloon loans. Most of my apartment buildings have balloon loans on them. What is a balloon loan? It's a mortgage that does not fully amortize over the term of your note, leaving you with a balance due at maturity, and the final payment is called a balloon payment because it has a large size. You've got a big balance due when a balloon loan comes due. Let me give you an example. A fixed rate 30-year amortizing loan for an apartment building might have a 10-year balloon term attached to it. I would call that a 30-10 balloon loan. That means that your payments are divided up as if you're paying off the apartment building over 30 years, but once you hit the 10-year mark, that schedule gets interrupted and your entire remaining loan balance is due in full, which, it means that at that time you owe one giant lump sum payment. Sounds a little scary, doesn't it? Well, paying that amount, typically in the hundreds of thousands of dollars or millions of dollars, all in one lump sum, well, that would hurt you bad. Most people like me that actually choose a balloon loan, I've actually selected it instead of the certainty of a 30-year no balloon option. I've done that with a couple things in mind, okay? First is that you wouldn't expect to pay cash from your own pocket at the 10-year mark. You expect to either sell the building or refinance the property at that time so that you could pay off the big lump sum balloon with the property proceeds and not from your pocket. The other reason that you would likely choose the 30-10 balloon loan over one that you would just pay off over 30 years with no balloon is that you typically get a lower interest rate with the balloon. The last apartment building I bought was like this, okay? Rather than a 30-year amortizing on the apartment building like the same type that you'd get on your single-family home, that had a multifamily apartment building rate at 6% fixed. I picked the 30-year with the 10-year balloon loan because the interest rate was 5.5% fixed, not 6%. Well, what does that do? See, that guarantees me a higher cash flow those first 10 years because my mortgage payment is now lower due to the lower interest rate. I'm willing to accept that risk because I have the confidence that 10 years after I buy the building, I'll have sufficient equity to make a profitable sale for a 1031 exchange, or worst case, I can refinance, though I'd likely have to settle for a higher interest rate in 10 years, which is a calculated risk. But see, I get the certainty, absolute certainty of higher cash flow in the meantime. So with a straight 30-year fixed amortization, the interest rate would have been 6%. I chose to add the 10-year balloon onto that, so I got 5.5%. And you know what else? I could have done a 7-year balloon, an even shorter period instead of the 10-year. And with the 7-year, gotten the interest rate down to 5.25. That quarter point lower, that would have further increased my cash flow. But you know what? The 7-year balloon made me uncomfortable. That exceeded my risk tolerance because in the metro that this apartment building is in, I didn't have the confidence that I would have enough appreciation by year 7 to have sufficient equity for a sale and a tax-deferred exchange. Each one of these apartment building loans also had a 5-year prepayment penalty. That's something that you don't typically have with smaller properties. Okay, with that prepayment penalty, I owe the bank a hefty fee if I pay off the loan in the first 5 years. So a 5-year prepayment penalty and a 7-year balloon loan, see, that would have boxed me into this tight window of having to take major action between year 5 and year 7. I didn't like that claustrophobic feeling, so I pushed the bookends open by stretching it out to a 10-year balloon instead of 7. And by the way, you might think that those interest rates that I mentioned are really low for apartment buildings, and they are, but that's a special financing program only to residents of my home state of Alaska. Your home state might have a special in-state financing program for apartment buildings as well. With 5+ unit apartment buildings, you also might have an interest-only option where you don't have to make any monthly principal payment. Now, to the uninitiated, an interest-only loan sounds reckless, but to the educated investor with a defined exit strategy, interest-only can be beautiful. When you don't have to make a principal payment at all, the amount of that principal payment that you didn't have to make becomes your extra cash flow. And when you realize that the return from property equity is always zero, you begin to understand why interest-onlys can make a lot of sense in many cases. So risk and balloon loans in apartment buildings, especially, your loan type might depend upon the market that you're in, and you have to ask yourself the question of how much appreciation do you expect when you go ahead and select your product. So in summary, with 5+ unit apartment building loans, give close consideration to your exit strategy when you're considering what loan product to select. And with 1 to 4 unit properties, you'll nearly always want to go with a 30-year loan, not the 15. Don't play it safe, play it smart. Well, I hope that you're living a prosperous life. I know a lot of people made resolutions a few weeks ago. A lot of people make resolutions for more prosperity. I'm not so much a resolution guy, but like you, my life isn't absolutely perfect. Everybody has something that they can work on. For one thing, I cannot seem to put down energy drinks. It's amazing how many of those I slam every day. Sometimes I wonder if I can get anything done without energy drinks, and sometimes I need to budget my time better. It seems like I will never clear the window of time that I need to write my first book. And even if I do make the time, I don't know how I could ever write that book without energy drinks. I seem to jam a Q-tip into each one of my eardrums after absolutely every shower that I take because it feels good. I understand that's not the best thing for me. Yes, there are probably bigger problems in life, but I can't afford to puncture my eardrum. I'm kind of an audio guy here, and in addition to being a slackjaw, if I can't hear well either, then I'm really not good for anybody. So everybody in the world has problems. Some are just bigger than others. I actually opened up and wrote you about some of my challenges in a Rich Dad Advisors article that I authored last month, and I sent that to you in our free newsletter, which you can get, by the way, at getricheducation.com. You can read all my blog articles at getricheducation.blog. Yeah, there's not a .com in that one. .blog is its own top-level domain. So you can read my free wealth-building articles at either getricheducation.blog or just sign up for the newsletter at getricheducation.com so that you'll get the blog and more great freebies. Today, I am in my hometown of beautiful and pristine Anchorage, Alaska, and we are smack dab in the heart of winter where I've been cross-country skiing. I've been pretty regular about getting into the gym too, and I'm doing some mountaineering with Get Rich Education's business developer, John Collins, and I'm also spending some of my time investing in real estate, of course. But this is the last show that I'll be doing from Anchorage for at least 3 weeks. That's because for the next 2 weeks, Get Rich Education's business developer, John Collins, and I will both be in the Central American nation of Costa Rica, and that's where I'll be broadcasting the show from. John and I are primarily going there for fun, although we might look at an agricultural investment while we're there. But yeah, it's largely leisure, hiking at Arenal Volcano, doing some sightseeing in San Jose, which is Costa Rica's largest city in a metro area of more than 2 million people. And then later, we'll head out to Costa Rica's Pacific coast, where there are some jungle trekking and surfing opportunities. You know my business developer and best friend John here. He was last on the show with me 12 episodes ago to tell you how it really feels to quit your job, to just walk away from a job that pays you between $100,000 and $200,000 per year. And John's doing great, and he's still on sabbatical. Speaking of Central America, you might remember that last winter I aired one episode from Panama about the coffee farm investing. You can learn more about that at getricheducation.com/coffee. I invest in that myself. It's fascinating to own your own half-acre coffee parcels, land that's titled to you, and receive cash flow from the sale of coffee beans. A great, smart way to diversify. I aired another show a year ago from Nicaragua, and Panama and Nicaragua are Costa Rica's next-door neighbors. So, yeah, you get these occasional geography lessons from this remorseless geography degree holder here. Next week, while John and I are in San Jose, Costa Rica, I'll be chatting with popular and polarizing economist and author Harry Dent here on the show. Harry Dent came on to GRE last year, and he made some brash predictions about the market, and now he indicates that he wants to update those since Donald Trump was elected president. A week or two after that, Hillary Hendershot of Profit Boss Radio will be stopping by GRE here. You might know of Hillary. She's done a TED Talk or two, and she has a great command of wealth mindset and wealth building strategy. And by the way, when I tell you what guests are appearing out in future weeks, I take a bit of a risk. For example, we haven't recorded interviews with Harry Dent or Hillary Hendershot yet. I just don't typically record shows 4 or 6 weeks in advance. And see, this way I'm able to keep the show more contemporaneous for you, and I'm able to reference things like what happened last week in the stock market or what happened with the Fed's interest rate policy the other day. The risk that I take is when I tell you whom is going to be on future shows so that you know what to expect. I just haven't recorded them yet. But you know what? Luckily, in the history of the show here, no guest that's had a spot to appear on Get Rich Education has ever canceled, not once. Well, today, right on the other side, we're going to chat with my friend and principal at Narada Real Estate Investments, Marco Santarelli. We're going to compare real estate investing to other investment classes. This is Get Rich Education.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Today's guest is an investor, author, and he's the founder of Narada Real Estate Investments. They're a national real estate investment firm providing turnkey cash flow investment property in growth markets, and they do it nationwide. He's also the host of the Passive Real Estate Investing Show. He purchased his first real estate investment at the age of 18, and he got licensed and sold real estate by the age of 23. He'd later acquire more than 83 units in 2004 and 2005. And today he's a licensed California real estate broker who runs several successful real estate companies with a focus on helping investors create wealth and passive income with, what else? You guessed it, real estate. Welcome back to Get Rich Education for your second appearance, Marco Santarelli.
Hey, thanks, Keith. Great to be back on your show.
Hey, it's so good to have you here, Marco. And real estate really is that investment class or asset class. Some people use those terms interchangeably. That what I like to say is it pays people 5 ways at the same time. There are 5 simultaneous profit centers with real estate. It's just one of my favorite things to invest in. Well, it is my favorite thing to invest in for those reasons. I'm not really in love with real estate. I'm in love with the investment vehicle and what it does for me. So just tell us a little bit about why you chose real estate compared to some of the other asset classes.
Well, Keith, I love real estate for the same reasons you do. It is a multifaceted investment where you have income and returns from different aspects of the investment. But the biggest thing with real estate is that you can leverage your investment. So I could actually borrow other people's money, i.e. the banks, and acquire a property with as little as 20% of my own cash. So that means the bank will lend me the money. The bank takes on the majority of the risk, quote unquote, of that property. So now I own the property entirely to myself, 100%. I get 100% of all the benefits. The bank doesn't get any of the benefits, but I now benefit from the cash flow and the increased equity in that property and the tax benefits, which include that magical depreciation. You cannot do that with any other asset or asset class. And so if you stop to think and you had to choose one and only one investment vehicle to get you from where you are today to where you want to get to, whatever that financial goal is of yours, which for most people I would imagine is a destination called financial freedom, then the fastest way and the most historically proven way to do that is through investment real estate. And if that's true, then you've probably answered a lot of your investment questions right there. Now, the next step is educate yourself about it and pull the trigger, actually do something and take some action. And that's what I did when I was 18, and that's what a lot of our clients do. And that's how they amass a fortune. And when I say fortune, I'm talking about cash flows to give you that financial freedom, get out of the rat race, and wealth in the form of equity that you can now reinvest and redeploy. So that's a long answer to your question.
You know, the remarkable thing to me, Marco, is most people, they really don't even understand all the ways that investment property pays them, even when they are an investment property investor. Someone might buy a property, own an income property for 10 years, sell it, and really never even understand, even after they cash out, that they were paid what I like to say 5 ways at the same time. Number 1, appreciation with leverage, like you said. Number 2, cash flow. Number 3, loan pay down made by others. Number 4, the tax benefits. And then number 5, the inflation hedging properties, which is kind of that phantom gain.
Yep.
And, you know, it's not like I'm here always trying to defend real estate because I come from some real estate family or I have some legacy that I want to keep intact or make more popular or something like that. It's just that I love what it does for me, so it makes so much sense. But life and investing is often a question of compared to what? It's that relativity. And there are other asset classes out there. So, you know, really, what is your definition of an asset class when you look across the spectrum of all the things you can invest in?
So when we talk about asset classes, we're simply talking about a grouping of similar types of investments. So let's just hypothetically say that you're investing in produce and you have apples, bananas, broccoli, and spinach. You would classify these asset classes as fruits and vegetables. Now, in the financial landscape, it's generally broken down this way. I don't like the way it's broken down, and we'll get to that here in a minute, but generally speaking, asset classes are defined as either an equity, and an equity is typically, stocks owning a piece of a company. Another type of asset class is fixed income, which is typically a debt or debt instrument. For example, people who lend money to the government or to a company in return for interest. Those are government bonds, corporate bonds, and the certificates of deposit or CDs, or what sometimes are referred to as certificates of depression, because you really don't get much of a return, right?
Certificates that are going to guarantee you don't even beat inflation, right?
Exactly. So, the yields are so low. Then the next category would be your hard assets like real estate and commodities. And these are owning something that has a physical property. And those are like natural resources, metals, precious metals. Those kind of go into that bucket of real estate and commodities. And then lastly, you have cash and cash equivalents. And these are typically, the cash you have stored in your savings account, you have it in your pocket, or maybe you're shoving it under your mattress. But those are just cash and cash equivalents. Those are the general types of asset classes as most people out in the financial world look at them.
What's your favorite and why? Or why don't you just talk about the interplay and the pros and cons of investing in some of those asset classes?
Well, I think the first thing we need to do is break those down into more understandable asset classes. And the reason I suggest this is because it's easier to talk about asset classes when you shuffle them around and categorize them a little differently, because then you can understand them from an investment perspective. And we talk to our clients that call us up and talk to our investment counselors about their investment strategy this way. And there's really four main categories, and you'll completely relate to this. So if I reshuffle what we just talked about into four different buckets, we can talk about paper assets. And these are things like stocks, bonds, mutual funds, retirement accounts, where you actually invest in stock options and stocks and other products. It would include stock futures, foreign exchange instruments like the Forex, which are basically just paper bills or like dollars, the pound, the euro, etc. Now, these are all paper assets. And so many people will say that they're not worth more than the paper it's printed on. And in many cases, that's true because their value is intrinsic and it's determined or it's defined by decree. We put a value on it and it's just a trade instrument, but you can't really do much with that piece of paper. So people who invest in paper assets are typically investing for capital gains, not so much cash flow. The only place where cash flow typically comes in with a paper asset is through stock dividends. And I don't see a lot of companies today paying stock dividends like they used to decades ago. The bottom line is that with paper assets, there are a lot to choose from. I mean, this is what Wall Street is made up of, is paper assets. And this is the default, de facto, go-to bucket that people end up going to when they're talking to their financial planner, financial advisor, stockbroker, you name it. This is where most of America, middle America, tends to go because they're forced into it, or they see the advertising about it, or their 401k plan at work kind of shoves them into it.
Yeah, most investors just don't even understand the concept of cash flow. They're so capital gain centric, and their financial advisor just goes ahead and reinforces that notion. So with paper assets, the most common one being stocks, you mentioned that there is the payment of dividends. So there is the cash flow potential beyond capital gains. But a lot of people don't realize that the average dividend paying stock of the S&P 500 yields 2%. That's the average dividend paying stock. So even if you did have that cash flow, that 2% doesn't even cover inflation. And, some people don't realize that dividend paying stocks, they're typically the older, stodgier companies that have profits and can go ahead and provide an investor with a dividend. And those older sort of established blue chip companies, they're the ones less likely to have rapid capital gains growth. So if you do get a greater dividend, typically you're sacrificing that in your capital gains growth with paper assets.
That's exactly right. And interestingly enough, up until 2013, the average dividend yield was 3.26%. And that's not adjusted for inflation. So the net result of that is you're about zero. I mean, you have a zero rate of return when you factor in inflation on your average dividend yield. I'm not sure if it's higher or lower right now, but it can't have changed all that much. So it's not really that lucrative and it's not exciting to me. There is one other way, by the way, to make cash flow out of paper assets. It's actually quite a more advanced technique or strategy. It's actually trading options. And there are different strategies in working with options, which is out of the scope of this episode. But you can create immediate cash flow using options with straddles and spreads and whatnot. But again, that's a more advanced topic. But let's continue and talk about the different buckets here. So we've talked about paper assets. The next bucket or asset class would be commodities. Commodities would include base metals like copper and zinc and other metals that are used in industry. They include precious metals like gold, silver, food such as corn and coffee and grains and sugar, and of course raw materials like oil, gas, cotton, etc. Now, again, commodities are generally a capital gain or loss type of investment. You don't buy futures contracts or other commodities, for cash flow. You're basically locking in a price, buying it at a different price, and whatever that spread becomes is what your capital gain is. So They're very myopic in terms of an investment. It's a one-time cash out, if you will. And, there are a lot of investors who are intrigued by commodities, but it's not where I think investors in general should start, because you do need to have a higher financial IQ to really do well in the commodity space. But if you like commodities, especially precious metals, it's an easy place to start, because for about $16 to $18, you can buy an ounce of silver. And so you can start a form of investing without cash flow, but a form of investing by stacking some precious metals to get you started. And it's a good inflation hedge. And then later you can move into other things like real estate.
Yeah, gold and silver do have a few distinct advantages, right? You can hold that bar of silver in your hand for just $18. There's zero counterparty risk with that. That's no one else's liability. That's 100% yours. It's completely tangible. And of course, the downfall is it doesn't pay you by the month.
Right, exactly. There's no cash flow. There's no stream of income, which is a good segue to the next bucket, and that is the asset class of businesses. And we love these shows. I mean, if I don't watch a lot of TV, but the two shows I actually do like and do watch were The Apprentice, and more recently we see Shark Tank. And this is great for the general public because they can get a feel of what entrepreneurship and business is all about. But if you're a business owner, you're an equity holder. You own a piece of a company, and that company, if it's a successful company, will generate income, cash flow for you in the form of salary or dividends. And so if you invest in your own business, your business, although it's the most complicated asset class to get involved in and be successful at, it also is the one asset class that provides the highest rate of returns. Your leverage potential is infinite. Your income potential is infinite. It is kind of the most beautiful, if you will, asset class out there. But it's not for everybody. Not everybody is a business owner or can be a business owner or can be an entrepreneur. If you're one of those people, well, you can invest in other people's businesses. You can help them expand or start their business, and you can participate in that growth and that cash flow and that success. So businesses are an asset class. And if you think about Robert Kiyosaki's cash flow quadrant, you've got your E and S's on the left, which are your employees and small business or self-employed owners on the left side, which are those people who are taxed the most. And then on the other side of that cash flow quadrant, you have your B and I, your business owners, which are typically larger business owners, or those who can walk away from their business. Those people make the largest incomes. And then below that, you have your I quadrant, which are your investments. Typically, these are your passive types of investments that have the greatest tax benefits. But if you place yourself in that B quadrant, you have very high potential for capital growth in the form of equity and for cash flow. And that's where that bucket resides.
Yeah, that's so interesting. I watched The Apprentice and the Shark Tank as well. Yeah, The Apprentice is interesting again now that Arnold Schwarzenegger runs it. Yeah, businesses, it can be a better asset or investment class than real estate. But as far as passivity goes, I think real estate probably has it over businesses. If you want to launch your own business, you really need to be a self-starter and you need to have some good ideas. But, if you have a lot of capital, you can kind of go OPB and invest in other people's businesses. But besides taking a lot of capital, that can also take a lot of knowledge. And of course, with real estate, it's just kind of more linear, and there's sort of a template already set for you, and you can get involved with a relatively small down payment with real estate.
You're absolutely right. And keep something in mind. If business is not for you, but you like the idea of business and you become involved in the business quadrant or the business category or asset class, and you do that by investing your capital into another person's business, well, effectively what you've done is you've invested in that very first asset class we talked about, which are paper assets. Because remember, if you're a stockholder in another company, yes, you're an equity holder, but you hold paper. You hold stock certificates as your form of ownership in that business. You're riding along on someone else's success. You're riding on their coattails by being an equity participant or a shareholder in that company. It's not actually your company, even though you're a shareholder. If you do create your own business, you're right. It is an active form of investing. It's not passive. And that leads into the fourth category, which is what you and I love the most, and that's real estate. Real estate, if you're investing as a buy and hold investor, it is a passive investment. If you're in that asset class, real estate becomes a formula for financial freedom because you have the cash flow from the property, the equity growth through amortization and appreciation, which builds your net worth. You have the tax benefits, including depreciation, and you have the ability to magnify and accelerate your wealth accumulation through leverage because you don't need 100% of your own capital to buy and hold and own a portfolio of real estate. So that's the passive route. Now, some people take an active route and they buy and fix and flip property and make chunks of cash. But if you're smart, what you'll do is you'll buy, fix, and flip, take that money and reinvest it into buy and hold property. And now you're actually holding that asset class of real estate, which is an income producing asset.
Yeah, I like buying someone else's fix and flip with turnkey real estate investing, which is one of the things you do over there at Norada, of course. And yeah, kind of the big two, real estate versus paper assets. I think a little bit about liquidity. Paper assets do have a liquidity advantage. You can get in and get out, but liquidity can also be a disadvantage because when something's highly liquid, you're more susceptible to panic selling. When one can panic sell, they might sell low and they might also buy high, which is the opposite of what we're supposed to do. So with real estate, since it's less liquid, we're less likely to get into a panic selling state and it's more stable. And also think a little bit about control. You know, with paper assets, you have significantly less control. You're not sitting inside a shareholder meeting at some company on the other side of the country, where with real estate, you do have control, yet you can make it relatively passive. You have control because through your manager, you can make tweaks to your portfolio, you can improve it, you can raise the rent, and so on.
Exactly. Yeah. You're the CEO of your own company when you have direct control, like income producing real estate. When you hold highly liquid assets like stocks, that high liquidity leads to potentially high volatility. And the reason for that is because there is a huge emotional component that drives the price of those paper assets. You don't see that in real estate because real estate moves very slow. And even if there is an emotional component and prices are changing within a market or a neighborhood, it's not that it changes dramatically tomorrow or next week. You usually see it coming because of changes in the job environment or the economic landscape or new employers coming in or large employers moving out of a market. So it's like comparing the rabbit to a turtle. You know, there's a snail pace with real estate and there's a volatile, sometimes microsecond change when it comes to stocks and other paper assets.
You mentioned cash equivalents a little bit earlier. Why don't we wrap up on cash equivalents, Marco? Cash equivalents is basically the ability for one to stay liquid and help move in and out of these asset classes. Tell us a little bit about the importance of cash equivalents and liquidity.
If you are sitting on cash, you know, whether that's in your mattress or in your pocket or in a savings account or any kind of bank account for that matter, in a deflationary environment, cash is king because the value, the purchasing power of that cash actually goes up. We are not in a deflationary environment. We haven't been for a long time. We could be in the near future, just the way things are unfolding. But if that happens, my estimation is that if we did enter a deflationary environment, it would be short-term and temporary. But we're typically in an inflationary environment because that's what the government needs and that's what the government wants. And that's what the Federal Reserve's mandate is to keep a very low or moderate inflationary environment. And this is why they, keep injecting new money into the system through quantitative easing and other programs. The issue with that is if you are sitting on a boatload of cash, whether it's $50,000 or $500,000 or whatever it may be, every year the purchasing power of that cash you're sitting on is diminished. So you're actually losing money. You're losing purchasing power. Now, why would you want to sit on cash or cash equivalents? The reason for that is twofold. One is for emergencies. You need emergency capital should something happen, whether it's a health-related problem or you lose your job. You want to have about 6 months worth of reserves to pay for your mortgage and your food and your bills and all that kind of stuff. The second thing is you want cash reserves because you want some dry powder if a good deal comes along. And good deals come along all the time. In fact, I've had a saying for a long time, the deal of the century comes along once a week. And just in the position that I'm in, with Norada Real Estate and the deals that we see across the country that, we obviously feed to our clients, I see deals all the time that I want to buy. But obviously, I just can't accumulate everything. So if you have cash, you have the ability to jump on a good deal when it comes along. And if you're in the market and you're actually looking, then you're ready to pull the trigger. You don't have to say, oh, I found a good deal. Now I have to go and find the cash for it. That might not happen because you'll lose the deal. So I'm not sure if I'm answering your question, but that's my commentary on cash.
There's opportunity cost to having too much liquidity because then it's not providing you with a return, but there's opportunity cost with not having enough liquidity because if you don't, then you hampered your ability to participate in deals. So, Marco, how could our listeners find out more about you?
Well, the best place is our two websites. Our real estate website, which is full of information, free information, as well as all our properties that come and go every week, is noradarealestate.com, Norada, realestate.com. And then for more free content, just like the quality content that people get from your show, they could listen to my podcast at passiverealestateinvesting.com.
Marco, it's always great to have you back on the show. It's always fun talking about our favorite topic. I really appreciate you being here again.
Yes, sir, Keith. I appreciate being invited back, and thank you very much.
Thanks, buddy. Yeah, like I say, doing the right thing is more important than doing things right. Real estate investing is that right thing. I don't know anyone that knows more about what turnkey real estate investors need than my friend Marco. I've even seen him make good with his own money from his pocket when something hasn't gone right with his investors. He's a principled guy. Your team is more important than your property. Be sure to check out Marco's resources. He's a friend of mine in this business. You've been hearing his company's Norada Real Estate commercial on GRE here for years because he knows that doing the right thing for his investors is even more important than doing things right. I'll be back next week with popular economist and author Harry Dent as I'll be virtually meeting you in San Jose, Costa Rica next week, where it's going to be like 75 degrees warmer than it is here now. Until then, I'm your host, Keith Weinhold. Here's to your health and happiness. Although you might quit your day job, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.